Hey everyone, this is Kirk here again from OptionAlpha.com, and today I wanted to show you guys and prove the implied volatility crush that we see when we talk about trades around earnings. And we're going to look at BBBY, that's three B's, which is Bed Bath & Beyond, because Bed Bath & Beyond honestly presents one of the best cases for implied volatility crush. We see one of the most dramatic drops in implied volatility right after Bed Bath & Beyond announces earnings. So this is a chart of the last 2 years of trading for Bed Bath & Beyond. And you can see down here on the bottom section of the chart, this is implied volatility kind of tracked along with the stock. So we have the stock up above, but down here below in green, this is that implied volatility that we're tracking. Now, what's important to notice about this is that we have such dramatic moves in implied volatility. And we say it all the time, right? We have to be on the right side of volatility. Well, now we can visually see when it comes to earnings that the right way to trade earnings is to trade earnings with an implied volatility move down. And we can visually see this because I've overlaid on this chart the actual earnings announcement every single time that Best Buy has earnings, Bed Bath & Beyond. You can see here that implied volatility drops sharply after that earnings announcement or the day of that earnings announcement. So now that we see this on a chart, this gives us an opportunity as traders to make a very, very targeted high probability trade. And again, all I want to do on this video is just focus on that drop in implied volatility. Now, just because the stock has a big drop in implied volatility, most people assume that that also correlates sometimes with a big move in the stock after earnings. And in the case of Bed Bath & Beyond, sometimes that is the case, as we'll see here in a second. Sometimes it's not. In the case of a couple times back before in March and April of last year, and then again in June of last year, you'll see that the stock had earnings and we saw that big drop in implied volatility, but the stock basically went nowhere after the market. So most people with earnings, try to play the market by entering a long position, right? So buying options on either end and assuming a huge move. But the better strategy, the more profitable strategy long term, is to actually play this by selling options around the stock the day before earnings and taking advantage of just that implied volatility move. And you can see we probably were able to take advantage of this a couple times before in the past, even with a little gap here and there with the stock, because implied volatility dropped so sharply after earnings that enabled us to sell option premium and take a profit. Now, obviously, we're going to have situations like we had at the beginning of last year with BBY, which we weren't part of this trade, thank God, but some people were, and implied volatility absolutely dropped, and the stock absolutely dropped. And so this again goes to show you, because another common myth is that if a stock has a big move lower and kind of gaps lower, most people would assume actually that implied volatility would rise at that point, right? So you'll hear a lot of traders that'll say implied volatility will rise as stocks fall. Well, in this case, the stock dropped almost $10, which is a huge move lower, and implied volatility still got cut more than 50%. So it was a big drop in implied volatility, and the stock fell by more than $10. Totally goes against the grain, but this is actually what happens, right? When you actually get in here and start looking at the charts, you can see what really happens and why we should be trading one strategy over another. So again, hopefully in this video, you again saw the power of the implied volatility crush that happens after earnings trades. I encourage you to go through a lot of different securities that are out there and look at the history of that drop in implied volatility that they have after or before, right before earnings for a lot of the stocks that you'll end up trading.